Exercise 18 out of Chapter 7 is a little more complicated. Let's take a look at it. It has the company sells land, so in general we know land's going to go down, and in exchange they receive a note. So it seems pretty straightforward. However, we've got to come up with some values for these items. For instance, the land itself. How much are we going to record as the decrease to land? Well, in the narrative, it gives us two numbers for land. It tells us the fair value, which would be its market value, is roughly $700,000. It also tells us that the cost of the land is $590,000. So when we go to make our journal entry to show land going out, do we take out cost or fair value? Well, we have to think, what's in the account for land? Well, I hope you recognize land gets reported at cost. So back from, on our prior chapter on the balance sheet, we looked at the value of various assets. These long-term physical assets get reported at cost. So cost is what's going to be in that account. So we're going to credit land $590,000 to take out the cost. Now let's go look at the note receivable. Well, the note receivable is for $1,101,460 with a 0% interest rate. So it says it's a 0% interest rate, but we have learned in Chapter 6 that a value in the future is not the same as a value today. So there's really no such thing, actually, as a 0% interest rate. So what we've got to do is figure out then, what's the real value? What's today's value or the present value of this future amount? So we'll take what we've got. We know that in 4 years, the future value is $1,101,460. So we'll put that into our calculator. There are no annuity payments. We don't know present value. We know N is 4. And then the interest rate. Well, here again, it says it's 0, but if you look at the very bottom of that particular problem, it tells you this particular company, if they went somewhere else and they had to borrow money, their normal borrowing rate is 12%. So we want to make this more realistic. This is really the economic substance of this transaction. Sometimes I think intermediate accounting really ought to just be labeled economic substance, because that's what an accountant often does. You look at a contract and you read it through, and you have to discern what's the underlying economic reality or the economic substance of what's going on. So we're really loaning money to our customer at their normal rate, 12%. Okay, we key all of that in, plug it into our calculator, and we should get $700,000. And you saw for the present value. And by the way, that should not be a surprise, because that's the fair value of the land. So if you think about it, the company gave up land with a fair value of $700,000, and they received a note that's worth $700,000 today. It's an equal exchange, isn't it? We received something worth $700,000, and we gave up something worth $700,000 at that point in time. Now, we didn't really have the land reported at $700,000, but that's what it's worth at the time of the transaction. Okay, so what's going to happen is our note is really worth $700,000. Now, we're going to make it worth $700,000, but we're going to do it this way. We're going to put the face value of that contract, or that note, in the note receivable. So we'll do that. But in order to get it down to $700,000, we need some sort of contra account. So we need some sort of contra account that'll do that for us. So, and again, what I mean by contra account, if I take the debit of $101,460 minus this credit of $401,460, I will get a net of $700,000. So we want the note receivable to net $700,000, and we'll do that through this account called discount discounts on notes payable, or discount on notes payable, excuse me, not notes payable, note receivable. Again, we're the debtor and not the creditor. Okay, so we have the discount on notes payable. We're still not in balance. Well, we're not in balance because let's compare what did we give up and what did we receive. Well, we received a note worth $700,000, right? And we've just netted that in these two accounts. So we received a note receivable worth $700,000. We gave up land. Our land in our accounting system had a cost of $590,000. So I just compare what did I receive versus what I gave up. Well, the difference is $110,000. And because I received more than I gave up, that's a gain. So let's go back up here and record our gain. So our gain on the disposal of land is $110,000. So if I add up my three credits, I'll get $1,101,460. Now another way is that I could have just said, okay, I have a debit here. These two credits, they don't equal. I still need another credit. I need a credit of 110. Well, if it's a credit, that's a gain. So I could have also just not solve for it this way, but just let the debits and credits balance out. We needed a credit to balance. If it's a credit, it's a gain. If I had needed a debit to balance, it would have been a loss. Okay, so we've got our original entry, and let's go post our $1,101,460 in our notes receivable account, and then also put in our discount on notes receivable, the $401,460, and those are going to net to our $700,000. Okay, so on 1231. I'll talk about that in a minute. So on 7/1/14, we have this particular balance, okay? And then that's all this problem really asks you to do, going through that. Now, I'm going to go beyond that because I want you to go beyond this for an Excel assignment. So I'm going to have you also do this exercise on Excel. I'm not going to have you do the journal entries. I want you to do a loan amortization schedule. And now you've already done a loan amortization schedule using Excel with Chapter 6. So we've already done that before. And I'm going to talk about that at the end of this video as well. So let's go through. We're going to solve for what your numbers ought to be, and then your assignment will be to go and put it in Excel. So let's work this whole problem through the 4 years. Now, to do that, I'm going to make things a little easier for us. We're going to change the date, and we're going to say this happened on December 31st, 2014. So let's change that date. That way we don't have to accrue interest and everything works out a little bit easier for the demo problem. So if that happened on December 31st, 2014, this is what we would see on the balance sheet. Notes receivable less a discount, and we would have a net balance of $700,000. Now let's also talk a little bit, what does this discount on notes receivable represent? Well, if we have a future value of $1,101,460 and a present value of $700,000, what's the difference in those two numbers? What is the difference between a present value and a future value? Well, if you recall from Chapter 6, the difference, that $401,460, is interest. So disregarding inflation, the difference between a value today and values in the future, that difference is interest. So this discount on notes receivable represents our future interest expense. Future interest revenue. I keep thinking we're the debtor, but we're not. We're the creditor. Okay, so that's our future interest revenue. Okay, so that's at the end of 2014. 2015, a whole year goes by, we want to recognize interest revenue. So we're going to take the 700,000 and then the 12%, and we'll get 84,000 for our annual interest. So we're going to plug that in to our journal entry here. And I want to take it out of the discount because that represented future interest revenue, and we've earned some of it, so we want to decrease the account for that. Let's post. So I'm going to post my 84,000 to the discount. That still gives me 1,101,460 in notes receivable. But now the balance in the discount is 317,460. So notes receivable less the discount. Now I have a new balance, 784,000. And those three numbers will go on the 2015 balance sheet. On the income statement, we'd have the $84,000 of interest revenue. Let's have another year go by. So another year goes by. This time, instead of 700,000 as our principal, we're going to earn interest on our interest, right? That's compounding of interest. So now we get to earn interest on the whole 784,000. So we earn interest, our 12%, on the 784,000, and that's going to be 94,080. 94,080. That in our journal entry. So now interest revenue has gone up because of compounding of interest. Let's post the debit to our discount, 94,080. So nothing happens to notes receivable, but the discount goes down to 223,380. So my notes receivable less the new balance. Now my net value is 878,080. 878,080. So those three numbers get reported on the balance sheet for 2016. Interest revenue, 94,000. Okay, another year goes by, and we're going to calculate interest revenue again. This time, we get to earn interest on the 878,080 at 12%. That's 105,370. So we just plug that in to our journal entry. Let's post our 105,370 in our discount account. Solve for our 2017 balances. Nothing happens to notes receivable because it just stays there, dormant. The new balance in the discount is 983,450. And we have a net amount, oh, I said that wrong, didn't I? I got ahead of myself. That can't be that much. That doesn't even make sense. Now the balance in the discount is going to be 118,010. 118,010. 118,000 0 1 0. 118,010. 118010. And the carrying value, or the net value, is what I told you earlier, 983,450. So then those three numbers go on the balance sheet. The 105,370 goes on the income statement. Last year. So we're going to recalculate a new interest because of compounding of interest. So we have this 983,450 at 12%. Hang on a minute. Okay, so then we have the 983,450 times 10%, and I think you're actually going to get something like 118,014, but we actually need it to be, we want this account to zero out, right? At the very end, this is going to be zero. So we need the debit to be 118,010, and it's not that, just due to rounding difference. So the reason we're off by $4, it's not an error, it's just because we've been rounding. So we're going to change this to 118,010, just to make that work out. Post the 118,010. That zeroes out the discount. At that point in time, we will have a balance, a net value. This 1,101,460 minus 0 will have a net balance of 1,101,460. However, there's one additional entry at the end of this period. We also are going to receive cash. Cash is going to come in, and the note receivable is going to go out. So here's the debit and credit. Cash comes in, note receivable goes down for the full 1,101,460. Okay, let's post that credit to notes receivable. And that will zero out the note receivable, and everything is 0, 0, 0. One last thing I want to point out. This is a long-term note, so it's long-term. First, in 2014, 15, 16, but in 2017, and within 1 year, it'll be paid off. So now it becomes a current asset. There really isn't a recording of the 1,101,460. I just put it there so you would see that balance right before the final cash collection. So this doesn't actually go on the balance sheet, because by the time you prepare your balance sheet, you've zeroed it out. I've switched over now to talk about your Excel assignment. I just want to review a little bit. In Chapter 6, you have already created a loan amortization table. So you may want to go back and edit that spreadsheet. You might find it easier just to create a new one for these assignments in Chapter 7. You'll have this data input area. So you are going to be solving for present value again, right? Out of exercise 18, we had to compute present value. So you'll be entering in data four of the 5 items, and you'll solve for the 5th unknown, which is present value. Now in this particular problem, we were the debtor, we had a payment. So you have to think about, what are the things that you're going to need to know? Well, same thing, we're going to want to know interest, except, this time it's going to be interest revenue. What's a little different this time is, instead of principal, we do have that, but we're actually going to have, a note receivable. And we also will have that discount. So then we're going to have that net value over here. We also don't have an annuity payment, so we're not really going to need this, are we? So we'll have interest revenue, note receivable, discount, and net value. And I also suggest, make the dates the same as what we've got in the homework. So 12/31, 14, 15, etc., etc. Okay, so that gives you an idea of, again, of setting up this problem. The other thing I want to make a point of, everything here, every cell in this area should have a formula. So make sure you have a formula for every cell in this area. As well, for present value. Now you're going to have 4 data inputs, but other than those 4 data inputs, you should have a formula here, and every cell here should have a formula. You may be referencing to something up here in order to do that. Okay? All right, you're set for being able to complete exercise 18, part 1.